Hello there. Welcome to Financial Accounting N4. We have got a question paper that we have here. Want to look at it today. It's a question paper on November 2022. So we have our first question here that we want to look at. The question reads, record the following transactions from 1.1 to 1.4 in the general ledger, in brackets, account debited and account credited, and indicate the effect it will have on the accounting equation. And then we are given the accounting equation, which is assets is equals to equity plus liabilities. And remember, equity represents owner's funds. And then we have got an example that we are given, and it's saying bought sugar with cash from the corner shop, which is 450 rands. And on this example, the solution is there. This is the example that we are going to follow in the answer section. So on this one, they have debited the sugar and then credited the bank. And then they've shown also the effect on the accounting equation by a reduction of 450 on assets and a reduction again of 450 on equity. So this is the example that we are going to follow as we enter these transactions that are below that. But basically, let's start by understanding this accounting equation. So we are going to first of all put down the double entry that is there, and we'll see which account is going to be debited and see which account is going to be credited. So when we have such a scenario, we have got our account to be debited and to be credited, then we see where this double entry effect is affecting in terms of assets, equity, and liabilities. So remember, this equation is saying assets is equal to equity plus liabilities. So what it means that if the transaction is increasing assets here, it's supposed to increase either equity or liabilities on this section. On the other side, remember, it's an equation. What is on this side here, we have got a demarcation. What is on this side, the total of this side should be equal to the total of this side. So if there's an increase here on assets, we should see an increase on either equity or liabilities. Let's say it's liabilities, and we saw an increase also. And if it's going to increase equity, you're going to also an increase, so that the total of the credit side becomes the same with the total of the debit side. The same thing happens if there's a decrease in assets, you're going to see a decrease in equity. And let's say this transaction is affecting equity and liabilities only. When we have such a scenario, it means that the transaction, if it's increasing liabilities, it should decrease now. We now have a negative relationship. It should decrease equity now, because they are on the same side. So if it's increases here and it decreases here, we would see that it comes back to zero. For example, if it's a plus 20 for liabilities, and then we have a minus 20 for equity. So it means it's coming back to zero, and the total of the credit will be the same with the total of the assets. But if it's affecting elements that are on different sides, we are going to see an increase and also an increase. If it's a decrease, we saw also a decrease. But if it's affecting equity and liabilities on the other side, they are on the same side, we should have an increase, which is followed by a decrease. So that's the scenario that we have. So if you look at our transaction, our example, we have got sugar, and we are seeing that this is affecting on the different sides. This one, equity and liabilities are on the other side, and we are seeing a decrease. So we are also seeing a decrease on assets, so that the total remains the same. So that's what we have there. So if you look at 1.1, 1.1 is saying both trading inventory on credit. So the first thing that we have to do is to identify the two accounts that are being affected there. So if you look here, we have got trading inventory being affected, and we see that this purchase was done on credit. And if it's done on credit, it means we are going to open the creditors account or the trade payables account. So the two accounts that are there, we have got inventory and trade payables. And we want to see which one is going to be debited and which one is going to be credited. So you'd see that trade inventory is an asset, so it's obviously debited. When you're receiving an asset, we debit. So trade inventory is going to be debited, and then we credit the creditors account or the trade payables account. So the amount is 1,500. So this is what we are going to effect there on our answer section. So if you go to our answer section, we have got a table that we have there where we have got transaction here. So this transaction is on 1.1. So we write here 1.1, and we are saying we are receiving inventory. So we are going to debit inventory. So here is inventory. And then the account that is going to be credited there is the trade payables. Remember, we said this is on credit. But if the inventory had been bought but on using check or cash, you're supposed to open the bank account and then credit the bank account or cash account. But this one is on credit. We are going to the trade payables control. So this is going to affect the trade payables control. And then the effect now, so we would want to see this debit it's on this debit side of the inventory account, and we are saying an inventory is an asset, so the inventory is on assets here. And when we are debiting an asset account, we are increasing the value of the assets because all assets have got normal debit balances. So here we are going to notice that there is a plus 1,500. The amount was 1,500. And also here now we are crediting trade payables, and you know that trade payables, they are liabilities, they are current liabilities. So we are also increasing, when you are crediting liabilities, you are increasing the value of liabilities. So it's a positive. So we are also going to have a positive here of 1,500. So the issue is that when we add on the other side, remember assets is on its side, then equity liabilities on the other side. We add here, we are supposed to add on the other side. So that's what we have. So the next one is 1.2. So we go back to see what transaction we have on 1.2. Right, here, let's try to move down so that we see what we have next. So if you go to 1.2, 1.2 reads a client settles his account of 3,000 rands and received a 5% settlement discount of 150 for paying within 30 days. So what we have there is that 3,000, we have a discount that is there of 5%. So we are going to say 0.05, which is 5%, and then we multiply by 3,000 to get the discount that was there. So if you multiply that one, you are supposed to get 150. So 150 is the discount. So this is a discount that is being given on a client, which means there were sales, and discount given on sales is discount allowed. So basically, you are seeing that we are going to have the discount allowed account also there. The discount allowed should be there, or we call it a settlement discount, which has been granted. So if you subtract now this 150 from the total amount of 3,000 to get the net amount that is there. So here, let's try to calculate that one. So to get the net figure now, we are saying 3,000, then we subtract 150, then we get, if you subtract 150, 2,850, right? So this is the amount that is going to be received. The other one, the other portion, which is 150, is going to be the discount. So remember, there are sales that has taken place. So we have 2,850 being received, then the remainder 150 is going to be discount. So in terms of double entry now, first of all, we are going to record the sales. Whenever there are sales, we receive cash. So it means we are going to have a bank account there. We are going to have a bank account, and then we go back to the transaction to see what is saying. Client settles his account of 3,000, receives a 5% settlement discount within 30 days. So we are debiting bank, and then we are going to credit the trade receivables account. Then we have got the trade receivables account. So these are two accounts that we have. And remember, we are receiving cash as there are sales. So we are going to debit bank, and we credit the account receivable account. So we are going to have two double entries that are going to be there. This one is recording the 2,850. Then the other one is we are going to record also for discounts. Remember, this is discount allowed, and it comes as an expense. So discount allowed. Remember, all expenses have got debit, normal debit entries. We debit all expense account, then all income account are credited. So here we can just call it settlement discount. We have a settlement discount. Settlement discount, and then the other account also we are going to credit the trade receivable account. Trade receivable account. So here we take note of the figures that are going to affect this one. Here, when we debit the bank and credit trade receivable, we are debiting the amount that has been received, which is 2,850 and 2,850. Then the treatment of a discount now, we are debiting discount, settlement discount is discount allowed with 150, and then we credit trade receivables with also 150. So this is the double entry that we have. So we are going to enter that and see now on the accounting equation how it's going to be affected. So if you come here, the first one was we were supposed to debit bank. We debit bank, and then we credit our trade receivables. Trade receivables. So this one we are debiting bank with 2,850, and then we credited receivables with 2,850. Then we see now the effect of bank. Remember, this is an asset, and you are debiting an asset. And remember, we said assets are got normal debit entry. So when we debit an asset, we are adding. So it's a positive. So here it means we are coming here, and then we are adding. We're adding 2,850. And trade receivables also, they are assets. Trade receivables, they are assets. And when we are crediting them, we are crediting an asset, we are reducing an asset. So it will be a negative. So here we are also going to see assets being affected twice with this transaction. And then we are also 2,800, negative 2,850. So that's what we have there. Negative 2,850. So remember, we've got two double entries that are there on 1.2. So see on 1.2, we are now recording the discount. Remember, we said the discount allowed, which we are terming here settlement discount. Settlement discount is going to be debited, and obviously we debit the trade receivables. Trade receivables. Right. So when we debit the settlement discount, this is going to be under operating expenses in the income statement as settlement discount as an expense, and then it's going to reduce the net profit. And on this side of the accounting equation, now you can see that when it's reducing the net profit, and we know that profit is the owner's equity. Profit becomes the owner's equity because the profit is going to increase the retained earnings or retained income balance. So when we are subtracting in the form of settlement discount or discount allowed under operating expenses, it means we are reducing the net profit. At the same time, we are saying it's reducing equity. So you are going to see that equity is going to be reduced here. So you are going to have a negative 150. And then on trade receivables, we are seeing that trade receivables is being credited here, and the trade receivables we are saying is an asset, and whenever I credit assets, it's a negative. So we are going to see also a negative 150 here. So that's what we have on 1.2. Then we move on to the next one and try to see on 1.3 what we have on 1.3. Right. Right, 1.3 is saying the secretary bought stationery for the accounting department from the petty cash, and it was for 125 rands. right? Here we have got stationery being bought. So it means obviously we are going to have a stationery account, and also we are going to have we are seeing that it's stationery that was bought using the petty cash, and also we are going to have the petty cash account because we are using petty cash. So we are having stationery. So we can write here, we have stationery. And then the other one is petty cash. Then we see now which one do we debit, which one do we credit. You see now stationery, we are receiving stationery. So we just use the simple concept that we debit the receiver and then we credit the giver. So the stationery is the one that we are receiving. We are buying stationery and then we are receiving stationery. So stationery is receiving. So we debit it. So we are debiting stationery, and we are paying cash. Cash is going out of the business. So we are giving cash. So we are going to credit here. So that's the double entry that we have there. And then we go on and summarize that one on the answer section and try to see how it affects the accounting equation. So this one is now 1.3. So on 1.3, we are saying we are debiting stationery. And then we are crediting petty cash. Right. So when you debit stationery, remember, when we debit stationery, here we are debiting stationery. So remember, stationery is an expense. We are buying stationery, and the stationery is going to be used in the business, so it becomes an expense. So when it's an expense, it's going to be under the operating expenses and going to reduce the net profit. And when it reduces the net profit, it's reducing retained income or retained earnings and reducing the owner's equity. Remember, retained earnings is part of the equity. So we're going to have a reduction there in equity of 125. And then also we've got crediting of petty cash. Petty cash is a cash. So petty cash, you know that it represents cash. So it's an asset. It's a no more debit entry or no more debit balance. So when we are crediting, we are reducing the balance. So it's a negative. So we're going also to see a negative 125 on this side under assets. So that's what we have on 1.3. Then the next one, which is the last one, is 1.4. So we can go on to check that one. On 1.4, it's saying, right, let's check there on 1.4. If you look at 1.4, it's saying a client, Mr. Crook, could not settle his account for 189, and management decided to write off the debt. So this basically is a bad debt. This amount is not going to be recovered, so we're going to write it off. So remember, this amount 489 was on the debit side under trade receivables. It was on the debit side under trade receivables. So when we are removing it, we are going to the credit side of the trade receivables and enter it there to remove it, 489. Then the corresponding entry is a bad debt, and we are going to open a credit losses account that we are going to debit. It's a bad debt account or a credit losses account. So basically the account that we have there, we have a credit losses account, a credit losses account. Then we have got also then we have another account that we have there is trade receivable. Then here also we have trade receivable. So the one that we are debiting is this one, credit losses. Remember, this is an expense. Credit losses is an expense, and this one we are crediting. We are crediting trade receivables, which is an asset. So we are making these entries using 489. So we go back there and summarize this one. All right. So if you come here now, we are on 1.4. Right. 1.4 here. So remember, we are saying we are debiting credit losses. So here, the credit losses, credit is coming in the sense that when we sold goods on credit, so these are the losses that we are making from selling goods on what on the credit. So that's how this credit is coming in, and then we also have the trade the trade receivables control. This trade receivables control here. And then the amount that we have is 489. And let's see how it's going to affect the accounting equation. So here we've got credit losses. Credit losses, we said it's an expense, it's going to be under operating expenses. And then it means it's going to affect the equity. Remember, expenses when we are going to reduce the figure for retained earnings. So we're going to see a reduction in equity of 489 here. And when we credit trade receivables, and remember, trade receivables is an asset. So when we are crediting it, we are reducing. So we are seeing also a reduction of 489 on the assets part. So this is what we have on the question one. This is what we have in question one. We can move on to question two. Right, this is question two. Let's try to read what is on question two. Question two reads, bakery traders is a retail business which always uses a markup of 20% on cost. The business makes use of the periodic inventory system. This is one of the valuation of inventory. So on the required part, it reads, study the trade receivables control account below and answer the questions. That is general ledger of bakery traders, and they've got trade receivables control account that we are given there. And then we have some questions that are following that trade receivables control account. So let's look at the first question. The first question is saying, calculate the balance on this account at the end of the month. So basically, what we are going to do is we are going to add what the total of the debit, and then we add the total of the credit. Then we compare the two, and we make the balance. Remember, the steps are that when you add the total of the debit, you put it there. You add the total of the credit, you put it there. Then the bigger side is going to be in between the double lines that are going to be below here. And then where we have got a smaller total, that's where you are going to have the balance CD. And the balance CD will be the difference between the bigger total and the lesser total. And the balance CD will be on the side with the lesser total. And then you put it there. Then the balance BD will be on the other side below the double lines. So basically, these are the steps that we use when we are balancing an account. So here, what we are going to do, we can just summarize in terms of the totals of the debits and the credits. So if you come here, you would see that if you look at it, you see that the debit side we've got 34,151 here, and got 46,100 here. That makes this debit side bigger than this one. So we can just start by calculating the difference. This one is the bigger side, obviously. So we are going to say 34,151. Then we add 46,100. Then we also add 1,920. Then we add 425. And also we add and also we have 2,833. 2,833. So this is what we have on the credit. Then we subtract the total of the debit. Sorry, this is what we have on the debit. So when we subtract now the total that we have on the credit side we have 24,825, and we add 325, and we add also 760, and we add 199. So that's what we have. So if you add the total of the debit that is here, we add these figures, you are supposed to get you are supposed to get 85,429. Then you subtract the total of the credit. So if you add these figures, you're supposed to get 26,109. So that's what we have there. So when you now say 85,429 minus 26,109, and the answer that you are supposed to get there is 59,000. It's now 59,320. So this is basically the balance that we have So let's see what the question requires there. The question is only asking for calculate the balance on this account at the end of the month. So what is going to happen there is that we have this balance, and then the second question is saying state whether it is a debit or credit balance. Very important question. So what we are supposed to do is like what I was saying. You are supposed to put double lines here, double lines on both the debit and the credit. And I was saying the bigger total, you put it in between the lines. So the bigger total is 85,429. So it's supposed to come here in between the lines, 85,429, 85,429. And then you go to the lesser side, which is the credit side. That's why we go to the lesser side. That's where we're going to give our balance, balance CD. And the balance CD is the balance that we got there, the balance between the bigger and the lesser side. So we got 59,320. So it's going to come here. Then the balance BD will come here, where we have got the bigger side below the double lines, and we write 59,320. So to answer this question of stating whether it's a debit or credit, you go where we have got the balance BT, which is on the debit side here. So that's where we have got our balance. So the balance is on the debit. The balance is on the debit. So this one, obviously, the answer is that it's a debit. So that is what we have there. So that's how we are supposed to respond on that one. Then you go to the next one. The next question now is saying, what does this balance indicate? What does this balance indicate? So remember, this is a trade receivables control, and we are saying it's summarizing in terms of all the people or businesses that we sold goods on, we sold goods to on credit. So the indication is that these are the people that are still owing us money that we sold goods to on credit. So that's the explanation in terms of what does this balance indicate. So we can just say total. It indicates total. It indicates total amounts due by customers. Total amounts due by customers. So this is the response on that one. Then we move on to the next question. The next question is 2.4 and it's saying name the control account of the amount of 46,100 on the debit side of the account. So 46,100 is here, and remember it's written sales journal. So this is the books of original entry where this 46,100 was taken, and here they're asking. There's a question mark. That's where they're asking what is it indicating. So basically, we are debiting the trade receivables, and obviously we are going to credit. We are going to credit the sales account. Remember, when we do sales on credit, we are going to debit the trade receivables or the debtors account. Then we credit the sales account, and you know that sales account is always credited. When we sell goods, we credit, whether we sell on credit or cash. When we are selling on cash, we are going to debit the cash or the bank, depending on whether we sold using cash or it was check. When it was check, we open a bank account. So in this sense, this amount obviously is indicating sales. So sales is the response that we have there. That's 2.4. So here we have sales. Then you go to the next one. State the folio references for the following contra accounts. State the folio references. And remember, the folio references is on this column. This one is the folio references that they are asking. So if you come here, we've got petty cash. So here they are saying which one is the folio reference of petty cash. Where did you get this information? Which book of original entry, or which subsidiary book or day book, or did we take this amount of 125? And here it's written petty cash. So obviously it's coming from the petty cash journal. So obviously that one is coming from the petty cash journal. So we are going to write petty cash journal there. We are going to write petty cash journal here. So our response is petty cash journal. So that's what we are going to do there. We have petty cash journal, petty cash journal, and then we can put a 5 in front of that. Or alternatively, you can just put it in abbreviations by saying petty cash journal in abbreviations, then you put your indication there. So that's what we have in terms of 2.5.1. Then we go to the next one. They're also asking about journal debits and credits. Journal debits and credits. And if you go there, we have got this journal debits and credits. This one is a journal debit, it's on journal credits. So these ones are written journal, only journal debits, no much information about them. But basically, this is a journal entry. And whenever there's a journal entry that has been made, journal entries are usually made in the general journal. And when they are made, usually it's an error that was made and they are correcting an error. So they make a journal entry. So the most appropriate answer there that we can put is that they are correcting some errors. So because journal entries usually they are used to correct errors. So journal debits and credits, there is correction of errors. Correction of errors, and the book that we have that records that correction of errors is the general journal. So here we are just going to indicate general journal. Right. We can also maybe write it in the form of abbreviations. That is GJ, and then we put our indication there. Then we've got 2.6 now is saying name the control account for the amount of 760 on the credit side of the account. So we go to the credit side of the account and see which amount is 760. Right. We have this one there is SRJ. So basically, this is a sales returns journal. This is a sales returns journal. So they are crediting trade receivables. So they are reducing the balance for trade receivables on the debit side. So whenever we have that, it means that these are goods that were retained by customers. So when they are retained, they reduce the amount owing of those customers. Because here on the debit side, we are indicating that these are the amounts that the customers are owing. But when they return goods to us, due to many reasons, that amount that they have retained is going to reduce the amount that they are owing. So this is indicating sales returns. So sales returns, also another name for sales returns, we can call them returns inwards. So here we can write sales returns. Sales returns. And then we've got the next one is saying describe one transaction that could possibly give rise to the entry of 1,920 on the debit side of the account. So we go again to see which one do we have for 1,920. Right. 1,920 is here. We are seeing it. 1,920 is being given a reference of cash payments journal, and it's a bank. It's a bank. So what happens is when these customers that are owing us money, when they pay their money through bank, we are going to credit them. Like here, it's indication of that it's a customer that has paid, and it's going to reduce the amount owing on the debit. So when we have a bank now appearing on the debit, it means this is a check. We assume that this is a check that was written, and then when it was at the bank, it was dishonored. It wasn't processed, maybe of many reasons that it wasn't successful to be processed. So maybe insufficient funds in the account of the payer. So the check may become dishonored, And then when it's dishonored, we are going to enter it on the debit side to reinstate the amount that we had written off here that it was paid. So we are returning the amount here to say it's still owing. The check wasn't processed. So this one is a dishonored check. It becomes a dishonored check, and usually it will be indicated by RD, which is refer to draw. So let's just go there and indicate that one, that it's a dishonored check. So here we have dishonored check, and it's usually shown as refer to draw RT. So that's what we have on 2.7. Then we go to the last one, which is 2.8. So if you go to 2.8, 2.8 is saying describe two transactions that could possibly give rise to the entry of 199 on the credit side of the account. So we go again to see 199. We have journal credits. So these ones are the ones that I was explaining, that they are journal entries, and usually when we have these journal entries, they indicate that there's a correction of an error that has been done. And obviously, here the response is that is correction of error. Correction of error. So this is the indication that we are going to give there on 2.8. Correction, or they want two reasons there, so we can put correction of errors as one. Correction of error. Correction of error also as one that we can indicate there. Then also, if for example, we have someone that we are buying goods from, we are selling goods to that person, and also we are buying goods to that person. We can also have this journal entry taking place. We are selling someone goods, and then we are also buying goods from that person. So we owe each other some amounts. So it means we are settling up in terms of the amounts the balance that we have between the two of us, between the two parties. So we can remove the amount that the customer is owing, and it settles the amount that we are owing the customer. So we make a journal entry like this one. So this can be also another reason that we have such. So we can also state that one, that it can be a transfer of balance. It can be a transfer. It can be a transfer of balance. So that is what we have there. So this one is the last question. So here we did question 1 and 2 on on November 2022. So stay tuned for more videos to come as we prepare for exams. Those who haven't subscribed, please subscribe and get notifications of new videos that are going to come. With that, we'll meet again in the next video.